Sell open 138 and buy to open the 1.
Okay, go ahead.
All right. Thank you, folks, for joining us here today. This is Dean Gallagher from Portfolio Builder. Today is Thursday, January 23rd, 2020. Want to thank you all for taking the time to join us in our daily webinar. Enjoy the education and ask questions along the way. Okay, we truly appreciate your time and attention to show you how boring successful trading can actually be when you have the right strategy. Many of our members make more than the cost of their membership during their trial, and our trading plan takes less than 2 minutes to execute at noon Eastern daily. Call me with any questions along the way. Okay, guys, my number is 505-322-7515. Make sure to save it to your cell phone or just write it down and tape it to your computer. Would love to help you with any questions along the way. And if you're listening to this on the recorded version, just call me with questions. If you're listening to this live, look, just jump in, guys, interact live with us and get the highest level of value from today's presentation. Okay, real quick, our methodology and our core focus built in the strategy really mimics Warren Buffett's number 1 and number 2 rules. Rule number 1, never lose money. Rule number 2, don't forget rule number 1. Okay. This is really cool, guys, because within literally a week's time, or if you start on Tuesday and go till Wednesday, you can quickly establish a hyper defensive portfolio. Plus, you'll eliminate business risk by owning a stake in 1,500 plus companies with just 4 ETFs. Okay, guys, and these are 1,500 of the best publicly traded companies on the planet. Trade alerts will be sent to you via text and email Monday through Friday at noon Eastern time. We engineer our positioning in coordination with the financial system and macro environment. Okay, so we're going to watch the market, guys, 18 hours a day, 5 days a week, so you don't have to. You can, enjoy your retirement or continue to work full time. Just take a few minutes to replicate what we do. Okay, live video webinar presentations daily at 12:05 Eastern, Monday through Friday. Okay, you can access the live presentation from our trade alert email we send out each day. Simply click on the image that looks like a play button. Please ask any questions to the live during the presentation. Just click on the icon to unmute your microphone or simply type in the chat box. You can always review our track record. We build trust with our clients by being 100% transparent with every position we've ever had. You can always access our track record at portfoliobuilder.io/track-record, or just go to portfoliobuilder.io, scroll to the bottom of the page, and click on the track record link. A few things that you'll need to have in place to get the most out of your trial. Number 1, a brokerage account set up to follow our trading plan that has option trading enabled. You can use real capital or simply paper trade. Then you can see how incredibly easy it is to give your hard-earned money the protection it deserves. Number 2, you're going to need the ability to take 1 to 2 minutes to follow our trade alerts released at noon Eastern. These alerts are by no means time sensitive at all. They simply need to be placed before the market closes at 4 Eastern. You're going to need a mobile phone to receive our text message trade alerts. Many of our clients take these trades on the go from the airport, restaurant, in the car, anywhere they have service. It's important to make sure you entered your cell phone number when you signed up for the trial. If you use the landline or you just didn't enter a number at all, email Ryan at portfoliobuilder.io. Make sure to tell him your full name, okay, and give him your email address and your cell phone number so he can make sure that you're in our system and get the text message delivered directly to your cell phone. Number 4, you're going to need an email provider that's in good working order so you can access our daily webinar invites. Our current asset allocation recommendation is as follows. Per $300,000, you're going to put 50% in equities, okay? And 40% of that is going to flow into SPY. 10% of that is going to flow into EEM. 40% of the capital is going to go into the TLT, okay? And 10% is going to go into GDX, okay? And for some reason, if you want to double that or triple that, simple math, just scale it up. Or if you want to start with about $75,000 to make your life easier, for every 100 shares of SPY you have, you're going to have 200 of EEM, TLT, and GDX. And with that, Jason, I'll go ahead and let you take over, bud.
Excellent. Thank you very much. All right, let me go ahead and flip to my screen. And hopefully you guys did have a chance to watch yesterday's analysis of the bond market. First thing I want to show you is the government is not letting a crisis go without reward for the US deficit. We've been watching them sling around $80 billion of debt at a time consistently. And that was actually a big jump from 72 billion at a time. Today, this just updated, and with the yields going a little lower and government's wanting to refinance its debt at lower interest rates, we can see a massive, massive pile scheduled for next week on the 27th. We have $45 billion of treasuries being sold, the 13-week T-bill, $39 billion for the 26-week, $26 billion for the 52-week. And then here's the massive load in the notes. Combined, we're looking at $113 billion hitting the mid-spectrum of the treasury market. Now, typically they do the 30-year bond at the start of the month. So not this coming week, but the next week, we could see them starting to sell that premium debt product, which is again that 30-year bond. Now they are planning to roll out the 20-year bond, which will sit in the TLT. So the bottom line is that, number one, we've seen the Fed making asset purchases this week. We're getting little feeds throughout the week that they are continuing to pick up treasuries. One, two, ECB came out today and did confirm they will continue with no rate cuts, which would be bullish for bonds. So they're not doing rate cuts, but they are going to continue 20 billion euro in purchases per month. So we're back to the same picture where QE, quantitative easing, equals a bullish stock market, whereas it equals rising yields on the long end of the curve at the same time. So we've not changed our mind despite all the negative news coming out overnight. China's stock market crashed, I think, limit down last night, 3.5%. The death count seems to have slowed down, and the spread of the virus seems to have slowed down. Now they've locked and quarantined out 7 cities. This is something I did dig up that is concerning. This is an article in February 2017. Inside the Chinese lab poised to study world's most dangerous pathogens. And this is in Wuhan, where this all began. So I'm not sure that the Chinese are being super honest with us with what exactly is going on. Two, I will continue to be on a high alert. The reason I didn't want to go long the TLT today was, number one, the big macro force is that, again, we're in a period of quantitative easing, bullish for stocks, bearish for bonds. So I don't want to forget that. Two, again, we saw this massive, gigantic jump in debt issuance into next week, which will put a lot of pressure on the TLT. And then three, we're not seeing the academic spread. The death count has slowed down and the number of infections have slowed down. And it does look like they're taking pretty dramatic precautions to slow down this. So I know the TLT has been a bumpy ride for us. Every time we have a big profit in the books, something happens, whether it's Iran or the coronavirus. Today's trade is similar to last week's, but even safer than last time. We are risking at most 28 cents. So a tiny, tiny amount of risk in this trade. Maximum profit is quite large. So we can earn $1.70 per share, $171 per contract, if the TLT does sell off to below 138 next week, where we hit our max profit. But if we're wrong, the contagion spreads, China's slowdown continues, stocks tank, well then, number one, I'll be happy to chase the equity crash using our SPY in emerging markets as data develops, or rather news develops on this front. But as of today, the best call I can make is to expect that this is the worst of the TLT spike, and that I do suspect we'll see it come back down. Now, again, that does assume that We don't see the death count start to double or triple in the next several days. And again, that we do see the Fed's balance sheet increase, which we'll get the update on that at 4:30 Eastern today, right when the market closes. And almost with certainty that figure will increase this week. Okay, so the trade alert today, to summarize, if you were assigned, you will need to repurchase your TLT shares and allow your 139 TLT put to expire worthless. If you were not assigned, you'll simply need to buy to close your short 136 TLT call. Step 2 is per 100 shares of the TLT, sell to open the January 31st 138 TLT call and buy to open the January 31st 140 TLT put. We have no changes in our GDX position. For every 100 shares of the GDX, you should be long the February 28th $29 GDX put. Here's the return on this trade. The TLT traveled from 139.03 to 141.30 for a gain of 227. However, we had the inverted option collar where we took an initial credit of 246. To exit that position, we had to give back 533, bringing our net loss to 60 cents a share. If we do scroll down on the SPY trade, our 330 put option started providing some value today as we dipped below 330 for a very short period of time. But once again, that was short-lived. My expectation is actually that if China continues to struggle, then we're really going to see another rush to safe havens looking at US dollar, US treasuries, and the US stock market. So unless we see the virus really spread into North America, I'm not too concerned for the SPY. So we'll see how this develops. It's still early on. It's hard to know if we can trust what's coming out of China. But so far, again, the death count has slowed down and the number of reported cases has slowed down. And now the world's on high alert. So our technology and means of communication has really greatly improved over the last 2 decades. When we had the SARS virus scare people in 2003, and from November through July of 2002 and 2003. So we're on close watch for this. But again, we can see the SPY's already bounced up to 330.48. TLT's standing still at 141.28. If things had gotten hairier, we would have been saved by our put option, while others would not have been. Currently, our option caller has delivered a substantial profit of 75 cents versus a cost of 20 cents. But that does not offset the temporary drawdown we are seeing in the SPY. But for our investors, rest assured, if things do get hairy and stocks crash through today into tomorrow, we know that we have the 330 put. So we walk away with 330 a share. Now, with all the market predictions for 2020, I don't think a single person predicted that we'd have a epidemic virus breakout in China. So it just goes to show that when you realize there's a lot of unknowns in the market, you can understand why we like to have that downside protection in all of our trades at all times. So we'll see if this continues to develop. I'm just very skeptical to break the big picture trade alerts here, which is to be long stocks during periods of QE, which they have essentially guaranteed us through April, through tax season. So that's one. And then two, we're not seeing any rate cuts. Rate cuts are what are so bullish for the TLT. So I do think that we have the right general idea for 2020 still. The big question remains, will China's growth rebound as this trade escalation, de-escalation continues? Also, another thing to consider is, will China get anywhere close to its promises to the United States in the phase 1 trade deal if this epidemic continues to worsen? So a lot of things that could happen and spiral out of control from this. For now, I'm still placing the same trade on TLT and remaining long GDX. Now you can see that because of the higher levels of risk, I have made our potential loss on this trade significantly lower. Now let's just go back to that and talk about the cost of having less risk. So as you can see, for this trade to profit, we do need the TLT to move in our direction. So until we get below 140 on the TLT, we have that maximum loss essentially set. So that's again 28 cents against a share value of $1.43. So the maximum risk between now and Thursday is really quite minimal. Almost, what is that? That's less than 0.25% being risked week over week. So closer to about 0.2% total loss on this part of our portfolio. If we're wrong, if we're correct, we can pick up just over a profit of 1.2%. So about a 5-to-1 reward to risk ratio going into this trade alert. The catch is that we do need the TLT to move. It can't just stay flat for us to generate a profit. But when I do see this massive amount of debt being sold next week, and perhaps the fear has already hit the maximum level with all these cities being shut down, that we might see a good sell-off in the TLT. So that's our trade alert on the TLT going into tomorrow. If things do get worse, going into our trade alert Friday, we can consider changing our outlook. But for now, the SPY is showing a lot of strength, and I do think TLT is in a top range. Okay, so that's a review of that trade. Emerging markets got hit, but we were smart to have the put option at the 44.73. Currently, it's at 44.53. So our put option has kicked in, and we cannot have any other losses in emerging markets between now and Tuesday. Now, interesting, China recently added $200 billion to its banking system in the form of repo or QE in the last 2 weeks. So we're seeing all the big central governments increase the money supply in 2020. GDX has a little bit of a bid, and I think as it continues to, as the gold market continues to see monetary policy print, the relative value of gold will continue to climb. So I really like this trade. And currently we just have the married put where we're long GDX, but we're protected with originally a very deep in the money put option. Now, if you're just joining us, you'll be getting into that put option for less. And we've really confirmed some of the things that were a little less certain when we first put this trade on. So we're starting to see everything go in the right direction for gold. Scrolling down, we have the summary of how to place these trades. So again, to close out the call option, you would buy to close your short January 24th, 136 call. And that's, again, if you were not assigned. If you were assigned, you can allow your put option to expire worthless and go directly to step 2, which again is to sell to open the January 31st, 138 call, and to buy to open the 140 put. And to reiterate, we're locking in the maximum loss, which is just under 0.2% going into the trade. We start seeing profits when the TLT goes below 140, and we'll hit our maximum profit if the TLT hits 138 or lower. Now that's when our profits will get cut off to a degree. Now, if there's some implied volatility making our put options worth a little more, we could slightly outperform the max profit of $1.70. So again, we're risking about 0.2% on 40% of our portfolio. So under 0.1% at risk week over week, and the opportunity to return 1.2% week over week. If we do look at our gold position, if you're just starting, you can jump into this position. This one, we are using a longer expiration, because my expectation was actually for stocks to rally first in early 2020. Of course, we've had some trouble in Iran first to slow this prediction down, and now we have this virus. So that has slowed down the rally in the stock market now twice. Okay, I do see some questions popping up. Okay. Great. Okay, so that's a good review. Let's go ahead and see what questions we have in the crowd now. We'll go ahead and unmute the audience. And 22 live, welcome everyone. If you have a microphone, we'd love to hear from you. I especially want to hear what Karen thinks. How's it going, Karen?
I have no idea what's going on. No, I'm serious. I was just traveling yesterday. Of course, I get back to Orlando, and I'm on the board of all this. Anyway, we got all kinds of stuff. We have a 5G outside my window that just decided to get put up, and nobody told us it was coming. So I'm going to fight with the city right now.
So you have been following. Yeah, they're keeping it kind of hush hush on the mainstream U.S.
Well,
they're talking about it a little bit, but
I was trying to listen to you last night doing all this research, and I just couldn't do everything. And I was out there tough anyway. So I have no idea what's going on, but I said, I gotta leave the meeting I was in. I said, I gotta go and do this trade for a second. I can come back in a little while because I've missed 2 days.
Yeah, sure. No problem. I'm actually going to switch over to my iPad for the screen really quick too, guys, so we can look at some charts together. Let's see if it's popping up here.
Yeah, thank you for the trade yesterday. I was actually on the bus. I couldn't listen, and I did the trade while I was on my phone. I haven't even had a chance to review it, but I'm so glad you sent it as quickly as you do, because that's all I had was a couple of minutes.
Oh, good.
So it's wonderful that you do that. I'm just saying it's terrific, because then I can count on it and then go back to wherever I was doing. Appreciate it.
Sure, no problem. Let's see who else we got out there, guys. All right, now can we see the iPad well? Wow, look how strong that SPY is. There's a look at the SPY, a little bit of a sell-off. Go back to my watch list. We can look at the TLT.
Yeah, it came down to ES. Came down to what was it? 3330, and got bought instantly as soon as it kind of hit a little bit of the volume support there. So
yeah, the Fed put is in place until April at a minimum. So I think it's going to take a major scare to break the SPY. Here's a look at the TLT, folks. So you can see it's had a very hard time getting yields below. Now just remember, if TLT is going up, that means yields are coming back. So when I look at this hitting this resistance, plus the government just stepping up the amount of debt it's going to put out in the market next week to almost quadruple what we're used to seeing. I think this is a pretty good trade setup, as long as, again, we don't see the death count start to really rack up faster. Okay, I think I see a question popping up. Yeah, you could certainly do that, Manny. So that would be a similar trade. You could buy the same put as I am. But yeah, you're not going to benefit from your call option depreciating. So
yeah.
The advantage of the covered call strategy is you're profiting from the call option losing value plus losing time premium, plus you're expecting your put option to appreciate. So if you do use a put, I would own a lot less of that and take very little risk. So with our setup, it's hard to get a setup where you have a 5-to-1 risk to reward ratio. And that can really only be designed by doing the inverted option collar.
Yeah, and you have to have a capital to buy the underlying asset, Manny. So you'd probably be better just to structure those forward ETFs, just because you just have such a higher risk to reward ratio by just buying the put. It's kind of takes all the safety out of the system completely.
Wow, that TLT did really pop up, didn't it?
Yeah, and the government didn't blink. They are clapping. But did you have a chance to see the massive issuance that they just updated today?
No, I haven't had a chance.
Okay, I'll flip it back to that screen in a moment.
Okay.
Let me see if I can actually.
Wow.
But yeah, you could see every time the yield gets to this level without a major crisis, it goes right back down. And yeah, they went and they just massively pumped up the amount of auctions next week. So on the 27th, they are unloading $240 billion of debt on the 27th and the 28th. So without U.S. stocks selling off, I would suspect this has to come back down.
So did you have a lot of people get their TLT called away?
I don't know. Anyone out there get called away, or are you still along the TLT this morning? Get a little strength in the dollar, which should be suspected. Now, if we pull up if you did watch the evening update yesterday, here's what I spent a lot of time analyzing. Here's our 30-year yield. Now, if we zoom out to the big picture,
The price of that.
so here's kind of a look at the big picture. And again, my expectation is for yields to spike higher, and that causes the stock market to have trouble. And then they go into a period of rate cuts. So my expectation is rates rise for most of 2020. And we can see the government is even trying to enforce this, adding the 20-year treasury, putting more pressure on the long end of the bond market, and then doing the massive QE. So that's the big picture right there. Is we're looking for a big green bar up representing rising yields. Now let me pull up the comparison against Germany, who's been a very good leading indicator for rates.
You know what I did with the last time with the put when we were sitting at a penny and you couldn't close it? I actually put in a limit order at like 2 cents, and it actually popped up to that at some point during the day. At least I got a little something out of it.
Really? Oh, cool. Yeah, you can always do that. Try that separately, just so you could get your short call taken care of, and then.
Yeah.
Okay, so the green line is the German 30-year bond, and the red line is the U.S. 30-year treasury. And so let me try to get a good chart for us. Okay, I see a comment from Ron. Long the TLT. It would have been a good trade week over week. That was quite a jump on the TLT. Let me just pull up just the TLT on its own. But yeah, every time we get to this level on the TLT, it's been that's been the top without a major crisis. So we'll be keeping a close eye. Let me go ahead and go back to the computer screen now, guys. I'll show you the debt. So yeah, this is the big picture of what's going to be affecting yields next week. And that is a lot of debt being issued. At 4:30 today, we'll be getting the Fed's update. My expectation is another increase in the balance sheet. So it's bullish for stocks. And again, bearish for bonds. Plus to see this massive increase in debt being issued next week. So unless we see that death count double, triple into the weekend, and the number of reported infections double, triple, quadruple in the next several days and throughout the weekend, there's still no change in our outlook for 2020 or our trading strategy. So we remain long stocks and short bonds, and that includes gold stocks. All right, guys, any questions out there? Now, today's video update will come out a little later. What I'm doing now is a daily update where I'm covering charts and news. I'll record today's right after the update is hit by the Fed and analyze its changes. Now, there is one thing I do want to point out that we were expecting would happen, but not this early. So this will be something we'll cover today once it does hit. So do check your email and text messages a little later this afternoon. This will be 30 minutes after the market closes. We're going to get that piece of data. So I'll probably do most of my analysis for tomorrow, leading into the 4:30 moment when this is updated. This is one of the big changes that we are suspecting just from the news feed, from announcements from the New York Fed.
Who's going to the back?
I'm just going to go on record that it was not me.
Good job. That was great.
Who's got their computer so close to the toilet? That's what I want to know. Maybe it's their phone. Too funny.
I'm sorry. Hey, you got to find some humor in all this, right? That's great.
Sure. No, sure. Okay. So here's the read on the balance sheet that
That was somebody's position.
Oh, I'm so glad we're all human, right?
Yep. Yep.
Okay.
I got a Twitter post of a Chinese man eating a live mouse as
Ugh.
so it's no wonder. Anyway,
Yeah, exactly. There's no wonder they're getting all diseased. Yeah, exactly.
yeah, and then this is very odd. This Chinese lab poised to study the world's most dangerous pathogens. This is in Wuhan, China, in February of 2017. So who knows if they've created this this disease on accident and it made it out.
It's like what's that movie that they contaminate like the whole town and then they try and quarantine it off and it just keeps going and going. How many movies have they made about that kind of stuff? I mean, here we go.
Right? Yeah. Yeah. So I'm going to keep a close eye on this. But when we look at the big macro picture, here's what's interesting. Leading up to today, they have only been purchasing the T-bills in this line. And we can see in the last update, they purchased $193 billion worth of T-bills, which is just massive. And I think it represents some 90% of the debt we issued in the previous week. Okay, so one. Two, last week they sold, or they allowed these to expire and not repurchase notes. So again, that's your 2-year, 5-year, 7-year, 10-year bonds. This week, we have started to see that they have made some purchases on the 1-year, 2-year, 3-year notes is what we're suspecting. But is it more than what they've allowed to roll off? Perhaps not. But we are seeing the Fed start to have to protect other pieces of the yield curve now by purchasing these different U.S. debt instruments. So it does look like the problem for the government to sell its debt is getting worse and not better, which means the Fed's balance sheet is going to continue growing. All this talk about the repo is going to continue. We saw China have to do a massive amount of repo in the last 2 weeks, $200 billion. So the big picture is the bond market's in trouble and the government's central banks are having to support the government debts by printing money, buying up its own debt, and that's increasing the money supply. So without failure, every time in history, this has been bullish for stocks and bearish for bonds. So far, there's just not enough of a catastrophe for me to change my mindset on this. But realizing this could continue to get worse, one, and then two, we still have some wild cards and potentially coming out of the impeachment. I did design this trade so that if we're incorrect, that we can risk very little. Again, 0.2% of our TLT position is at risk, and we can gain 1.2%. So it's a 5-to-1 risk to reward ratio. So that's number one. Two, if we're also wrong, then stocks should sell off. Don't forget we have the 330 put. So we're protected on all assets with put options. So we dipped below 330 for a very short period of time today, and it went right back up, which does not surprise me. Emerging markets is below our put, so we cannot lose a penny more on that position. We're completely protected. And then GDX is gone up a little bit today from all this, but not a whole lot, up 18 cents a share on the GDX position. So for me, number one, I really want to see how much the Fed's balance sheet increased today at 230. If it has increased, it'll be very difficult for me not to place another bullish trade on the SPY come tomorrow. We're locked into our TLT trade till next Thursday, which I'm fine with. I did consider placing this trade to have a longer duration, but decided against it and just designed it to have that low risk profile. From that standpoint, emerging markets, unless this really does get worse, which I think we'll know by Tuesday, I will most likely do the same trade on emerging markets. But if we do see that things are getting worse in China, I'll be considering a short emerging market 1 week inverted option on emerging markets. So we'll just have to judge the news as it comes in. And yeah, that's our position. So we're seeing the value of our put options today on the SPY for at least a moment. And we're repositioned to profit from a sell-off in the TLT going into next week.
Okay, so I may have missed this. You may have already said something about this. These new 20-year bonds that they're going to be issuing, are those actually available, or is that coming? And is that already calculated into the TLT, or is that kind of,
Yeah, so it's coming, and they're also going to create a 50 and 100 year. So
I heard Mnuchin this morning. That was one thing I did hear.
Yeah. So yeah, he was did a little interview in Davos today, and
yeah,
the 20-year they decided to choose because the technology is ready to roll out instantly. So that was the only reason why.
It sounded easy to do. Yeah, like it was a no-brainer, right?
So their plans this year, everything they're doing is going to put pressure on the bond market. So number one, we have this massive increase in defense spending. To get that approved, they had to do a whole bunch of different social programs. So that's why the deficit's so huge this year. 1, 2, they're starting to move more of the debt to the long end of the treasury curve. So that's why they announced the 20-year treasury. Okay, the technology for the 20-year treasury is already available. So we could probably see that being issued in the near future. So that would fit into the TLT. And then 3, they are now planning after this a 50-year and 100-year treasury. So if the US's plans are basically to try to refinance trillions of dollars into the long end of the bond market, that's going to be a lot of pressure on the TLT. So yeah, there's really nothing going in the favor of the bond market except for these little fears that keep popping up. The Iran issue number 1, but that's died down. Now we're worrying about this contagion, but as long as that dies down, the overwhelming force is going to be for rising yields.
All right, so it's coming, but do we have an idea of when? And so we know when it's going to affect, and how substantially do you think it will affect the TLT? I mean,
so they're not committing to the quantity of the debt to be sold until really just days before. So that's why I have this link bookmarked and watch it every day.
Gotcha.
And this literally because of this drop in yields, I believe they've loaded up. They're not going to let this crisis go unserved. And so for the government's mindset, this is an opportunity to sell a lot of debt for cheap. And we've been watching this daily. It's been averaging more like $72 billion a pop, not 210. So this is just a massive, massive amount of debt being issued next week. And this is not even the long end of the treasury curve. That will come out the next week.
Wow. Yeah, and then I heard him say, I guess the 50-year, 100-year, whatever. And he was pretty nonchalant about it. I guess talking about that I heard. I don't know if it was him or somebody else saying it was probably going to get tied to infrastructure. Which, of course, there you go. That makes sense, but it's interesting. And then how
then we're doing tax cuts this year. So
yeah.
So there's some more pressure for your bond market.
Yeah. What did I hear? Trump was saying he'd love to have the interest rates lower so he could refinance the debt.
Yeah, Trump's saying he wants 0% interest rates. So
yeah.
Yeah. Good luck.
Wait to refinance again.
Buy 5,000, 2024.
Yeah. And then
Buy 500.
yesterday we looked at their projected balance sheet, which is a joke. So yeah, just the amount of debt from every angle, the United States is getting hit at with its debt consumption, and there's no end in sight, especially in the short term. So yeah, if they want to get rates lower, they need a crisis to accompany it. So we never see the Fed cut interest rates unless there's a crisis. And usually that crisis is a stock market crash. So if we get a stock market crash, then we get rate cuts, and then we get QE. And they do it in that pattern almost without exception. So we had rate cuts last year. Now we're doing quantitative easing. And it's just going to be and also if you read their Fed minutes that came out in the last meeting, they're very concerned about not hitting their inflation objective of 2%.
Right.
So to create inflation, you print. So they've essentially said, they're going to print their little heart out until they get some inflation.
There was something else that was kind of interesting that came out of what was it, yesterday morning? Was when I was watching something, whenever it was. I guess it was early. It was before my flight. When Trump actually convinced the head of the WTO to reconsider China and India and get them out of the dark ages, because that's been a big problem, over the years with all the other countries, and trying to operate on equal footing. I mean, they act like they're not equal, and they're not. They're still emerging. No, they're not. they're there, and they've been there for a long time. So I wonder how that's going to play out, over time as well, with the bond market, because if they finally, even if the WTO is no longer considering that puts them, where they all thought 20 years ago they should have been, or they were trying to get to. And I think it's a great thing that he did. And I think a lot of business leaders were pretty happy with that too. So that was a very, very interesting moment, I thought. So we'll see what happens with that.
Okay, see one comment from Manny says they're buying 223 billion. No, they're selling 223 billion of U.S. debt next in 2 days, on the 27th and the 28th. So that is a lot of pressure. So we got to keep in mind, most of the U.S. debt is in these three strikes, or durations: 13-week, 26-week, 52-week. So it allows the U.S. to constantly refinance its debt and keep it rolling, which is good in an environment where you suspect rates in the general term are going to go lower and lower, which is really the trap that the banking system is in. Make no mistake, in the long run, I think TLT is going far higher, and I do believe rates are going much lower. But for me, the big picture is that, number one, right now, we're not in a period of rate cuts, which is the main driver of interest rates. So the Fed, the ECB have said time and time again that they are not cutting rates in 2020. That's one. Two, they are buying up government debt. So they're trying to control those yields. And as they expand the money supply, that puts pressure for stocks to go up and takes pressure off bonds. So we do see perhaps the opposite of what you would expect. But when the government buys up its own debt, we get rising yields and a bullish stock market, almost without failure. It's really when they stop doing QE that you need to become concerned with what happens next. So right now, they have essentially guaranteed us they will keep buying debt and doing QE through April. So come May, this could be concerning, because now they're going to see if the stock market has legs on its own, or if it's just been a expansion of the money supply that's driven this big rally. So that's one. Two, we got the ECB doing the same thing. They just had their latest meeting overnight. They're not changing rates, and they're going to keep buying 20 billion euro per month. So they're all doing the exact same thing. And outside of some sort of catastrophe, I really like our positioning and remain firm on our 2020 strategy. Now, keep in mind, once we get to April, which is not too far away, we'll have to be closely monitoring what's going on in the repo markets, where yields have risen to, assuming they rise, and then start trying to get some insights as to whether the Fed will continue QE beyond April, or if they're going to start weaning it off. And if they're going to wean it off, as yields have gotten more attractive, that could create the exact opposite trade that we're currently in. See, Murray, you're out there. I saw it. I think you have your microphone on. Oh, you got your mic muted. Well, all right, guys. Any questions? As we're looking, the SPY's at 330.50. TLT's sitting there right at 141.31. And emerging markets put options kicked in. Our put option on the SPY was kicking in this morning, but now we're back into right in the middle of our option collar, or just right towards the bottom bound. And so, yeah, I think perhaps we've seen the worst of the TLT pop. And next week, this massive influx of issuance will put a lot of pressure on it. Okay, great. Well, keep in mind, today we will issue the evening update again right after I'm able to go through the Fed's H4.1 release, which just details what they've bought and sold. We'll be expecting an increase in their balance sheet. And we'll also be paying close attention to the change in their notes, which I was seeing some highlights that they were buying some notes this week. Perhaps it's not nearly enough to offset the amount of notes expiring. So we'll keep a close eye on that. Why, if they start controlling the yield on the notes and the bond market, then that could be something to affect our TLT trade. So right now they're not touching the bonds. They're allowing the notes and bonds to sell off, and they're just gobbling up the T-bills. And so that's actually what they're anticipating may happen come April, is that once they believe yields are at the right level to sell foreigners, they're going to control those and not allow them to get too high, as they know that could cause a stock crash, just as we saw in October of 2018 when the 10-year hit 3%. Okay, last chance. Any questions?
I'm just going to tell you, make a comment that I do like those evening reviews. That was very helpful. It just kind of tidies up everything and kind of sets the tone for the next day. So I appreciate that. Thank you.
Okay, cool. Yeah, I really enjoy doing that. I was trying to squish it into our webinar, but I really like separating it. That way we can focus 100% on our trade alert during the webinar, get through that, and then I can spend the rest of the evening doing the proper research, pulling up the right charts, data, and then recording all those little clips and putting it together. So I'm glad to hear it.
Good. There's so much dynamic going on right now. It just seems to really tidy it all up. And I thought that was really good. So I like it. Thanks.
Okay, great. Well, that's great feedback. Okay, Manny says, thanks for sharing your thought process and as to why you're doing what you're doing. Oh, well, thanks, Manny. Appreciate it. Any last comments from you, Dean?
No, I see Oscar has his microphone unmuted. Any questions real quick, Oscar?
No, that was my mistake. As always, thanks, Jason, for the education.
Oh, you're welcome. Thanks, Oscar.
Thanks, Oscar. Keep getting better, bud.
All right, thanks, guys.
All right. Any last questions out there, folks? Anything at all? And Jason, I'll pull up my screen just one last time before we close out here.
Okay, let me make you the host so you can do that.
Okay, sounds good.
Okay, go ahead.
Okay, guys. If if you do have any questions that come to you after we get off the live webinar here, just feel free to give me a call. My number's right here at the top of the screen, 505-322-7515. That is my cell phone number. Definitely save it. More than happy to go over any questions you may have. Manny, call me too, but I'd be happy, or if you want, just email me at dean@portfolio builder. Happy to help you structure, a portfolio with the amount of capital you have. And folks, just if you have any questions at all, look forward to speaking with you and helping you address any questions that you may have. And I understand people are can be shy in the webinar, so please feel free to call me after. Be more than happy to help in any way I can. So thank you very much, folks. With that, we will go ahead and close it out. Jason, excellent presentation.
Okay, guys. Sorry, we had a nice win on the TLT and it just got snapped out of our hands. I still am very confident in this trade and appreciate everyone. So we'll see you tomorrow. Look for the update this evening. We'll see how much that Fed's printed, and we'll go with it tomorrow. So thank you so much.
Thank you, team. Have a great day.